Welcome to the Explainer. If you're gearing up for banking or civil service exams, you're going to want to listen up. Today, we are breaking down the RBI's brand new Priority Sector Lending Guidelines for 2025. This is absolutely essential stuff, so let's dive right in and get you ready.
So, let's start with the big question that really gets to the heart of this whole policy. How does the Reserve Bank of India, actually steer the country's massive banking system to pump money into the sectors that need it the most?
Well, the answer lies in this really powerful policy tool. Think of it as the RBI playing traffic cop for the flow of money, making sure it doesn't just go to the most profitable places, but that it also reaches the very foundations of our economy. It's all about making sure that growth is fair and touches everyone.
So what exactly is priority sector lending, or PSL as you'll always see it? Here is the definition you absolutely need to have locked in. It's a mandate, not a suggestion, from the RBI. It forces banks to set aside a specific chunk of their loans for these high-priority areas that might otherwise get ignored.
And here are the 8 official categories that the RBI has put on that priority list. These are the engines of growth that the policy is designed to fuel. We're talking about everything from farming and small businesses to getting an education, building a home, and even investing in green energy.
Now, and this is super important, it is not a one-size-fits-all rule. The RBI is way smarter than that. It actually sets different targets for different types of banks. Understanding this distinction, absolutely critical for your exams.
And this table just lays it all out perfectly. Just look at the huge difference in that first column, total PSL. Your big commercial banks have a 40% target, but check out the regional rural banks and small finance banks. They have a massive 75% target. That makes perfect sense, right? Their whole purpose is to work at the grassroots level. And also keep an eye on those sub-targets. They ensure money is spread around within the big categories.
Okay, you are going to see this acronym everywhere, ANBC. Don't let it scare you, it's just key jargon. All it means is the total, eligible amount of money a bank has lent out. It's the baseline, the denominator, that the RBI uses to calculate all those percentages we just looked at. Simple as that.
All right, let's get to another key piece of new jargon from these 2025 guidelines, and trust me, this isn't just a small change. This signals a really big shift in the RBI's strategy for agricultural lending.
So the RBI has created this brand new category called non-corporate farmers, or NCFs. Now, why does this matter so much? Because it's a very deliberate move to make sure that farm loans actually reach the small, individual farmers and local groups, the real backbone of our rural economy, instead of just being snapped up by huge corporations. And to make sure it happens, there's a new rule. 14% of loans, inside the total 18% for agriculture, must go to these NCFs. Okay, now for the real core of the 2025 update, the new loan limits. This is classic exam territory, comparing the old numbers with the new ones, so you'll definitely want to pay close attention to the next few slides. As you can see, the limits are up pretty much across the board for farm credit. But wow, look at the change for farmer-producer organizations, or FPOs. For those with guaranteed buyers, the limit has literally doubled to a massive 10 crore rupees. That is a huge signal of support for farmer collectives. Here is a number you should probably just burn into your brain. 50 crore. For the first time ever, loans up to 50 crore rupees for startups, as long as they fit the MSME definition, are now included under priority sector lending. This is a potential game changer for India's startup scene. And the momentum continues in other key areas. The limit for education loans is up to 25 lakhs now. And for social infrastructure projects, things like building schools or hospitals, those limits have gotten a pretty healthy boost too, which should encourage more investment in these vital public services. And now for a little bit of good news for anyone who hates memorizing complicated rules. The old system for housing loans, which was based on all these different population tiers, has been totally streamlined. Now it's just 2 simple categories. Much, much easier to remember and apply. Okay, this next part is, I think, one of the most interesting and groundbreaking changes in the whole update. The RBI is finally taking on a huge, persistent problem. The fact that some parts of the country get way too much credit, while others are basically left in the dark. This is a major innovation. So how are they going to fix it? With a really clever incentive. Get this, for any new PSL loans given out in districts with very low credit availability, we're talking less than 9,000 rupees per person, the bank gets a bonus. For every 100 rupees they lend, the RBI will count it as 125 rupees toward their target. Pretty cool, huh? And you guessed it, there's a stick to go with that carrot.
On the flip side, for any new loans in districts that are already flooded with credit, over 40,000 rupees per person, the bank gets a penalty. Their 100 rupee loan will only count as 90 rupees. This creates a really clear financial reason for banks to look for new areas to lend in.
And this chart just shows you the sheer scale of the issue. This is not a small problem. As of 2025, the RBI has pinpointed 196 districts that need more credit and will get the bonus, and 198 that have too much and will get the penalty. This whole new system is designed to completely rebalance that credit map.
So, it's really crucial to see the bigger picture here. These aren't just random tweaks to the rules. This is a full-on strategic reset by the RBI. It's about making credit fairer, actively fixing those regional gaps, and making sure the entire banking system is pulling in the same direction as the country's development goals.
All right, let's nail down the key takeaways. This is your exam-ready summary of what you absolutely have to know. First, that new focus on non-corporate farmers. Second, those increased limits for farm credit, education, and startups. Third, the super innovative regional balancing mechanism. And fourth, the simplification of the housing loan rules. If you can explain these 4 points, you are in great shape.
So we'll leave you with this final thought to chew on. The policy is ambitious, the design is clever, but the real question is, will it actually work? Will this new incentive system truly rebalance India's credit landscape for good? The answer to that is going to shape our economy for many, many years to come.